Welcome to the Tokenized Economy. Today's explainer is all about the broker-dealer model, a really clever financial structure that is completely changing the game for tokenized stocks. Let's get right into it.
So, in our last explainer, we dug into the CSD model. And remember, with that setup, tokenization is basically a new layer that sits on top of the market infrastructure we already have. Legal ownership in that world stays firmly anchored in the central securities depository.
But that brings up a really crucial question. What happens when we step outside of those traditional structures? What does tokenization look like when it's not tied to those old financial rails? Well, that's exactly what we're here to unpack. And the answer is a setup called the broker-dealer model. And believe me, it completely flips the script. Instead of tokenizing the actual share itself, a broker-dealer goes out, holds the stock, and then issues a totally separate token that gives you economic exposure to how that stock performs.
Okay, so let's be crystal clear on this. Investors in this model aren't trading the actual share. What they're trading is a token. You can think of it like a digital IOU, or a claim on the value of that share, its price movements, any dividends it pays out, but without you ever actually owning the legal certificate. This is what people often call a wrapped equity.
So, how does this actually work step by step? Well, first, a broker buys the real stock and parks it with a custodian for safekeeping. Then, and this is important, they segregate those shares, making sure each one is specifically earmarked to back a token. After that, they issue the tokens onto a blockchain. And finally, you, the investor, can buy and trade these tokens, which perfectly track the financial performance of the stock they represent.
Now, this whole model creates a fundamental split that we absolutely have to understand. And that's the difference between legal ownership and economic exposure. They are not the same thing here.
Here's the core distinction. On one side, you have the broker or their custodian. They are the legal owner. Their name is literally on the share certificate. But on the other side, you have the investor. The investor holds a token that gives them the economic rights. They get all the financial upside, the price changes, the dividends, but critically, this usually doesn't come with traditional shareholder rights, like voting in a company meeting.
And hey, this isn't just a theory on a whiteboard. This model is already being used by some major players out there. So let's take a look at how it works in the wild.
Let's start with Robinhood in Europe. They offer tokenized access to US stocks. Now, while the tokens are technically issued on a public blockchain, all the trading is really designed to happen inside Robinhood's own platform. It's a perfect example of creating a sort of walled garden for this kind of economic exposure.
Then you've got a company like Ondo, which is taking a completely different path. They issue their tokenized equity exposure on public blockchains like Ethereum. This means that after an initial check, these tokens can move freely out into the broader crypto world. They can be traded on decentralized exchanges and even plugged into other on-chain applications. It's a much more open approach.
It's also really important to know that not all of these tokens are created equal. Some are fully backed, meaning for every single token out there, there's one real share sitting in a vault somewhere. But others are more synthetic. They just use financial contracts to mimic the price of the asset without that direct one-to-one backing.
So you might be wondering, why go through all this complexity? What's the point of splitting ownership from exposure like this? Well, let's break down the pros and cons.
The benefits are actually pretty huge. This model can offer global access to markets, totally breaking down old geographic barriers. It allows for 24/7 trading way outside of normal market hours. It makes fractional ownership incredibly simple. And it creates amazing flexibility for how these assets can be distributed and used in the digital world. It really does open up access for a lot of people.
But, and this is a big but, that flexibility comes with a trade-off. Your investment is now completely dependent on the company that issued the token. You are trusting them and only them to actually hold the underlying asset. This introduces a whole new layer of risk, what we call counterparty risk. You're basically shifting your trust from the entire market system to one specific company.
So if you remember just one thing from all this, make it this. The broker-dealer model is all about providing tokenized access to an asset's value, not direct ownership of the asset itself. And that single distinction is what unlocks all of these new possibilities, but also creates new things for you as an investor to think about.
Now, this is just one piece of a much larger puzzle. In our next explainer, we're going to dive into the exchange-led model and see how the big trading venues themselves are starting to build tokenization directly into their own market structures.
If you want to keep up with this fast-changing world of tokenization, make sure you subscribe. And hey, drop any questions or topics you want us to cover next in the comments below. We'd love to hear from you. Thanks for watching.